This is the interpretation of accounts of Shannon PLC. We're looking at the 2019 paper. And what we're going to look at now is the section B, the part B. So basically commenting on the performance of the company. Forget the information that I'm going to go through. What I kind of want to discuss with you first is this question here, Shannon PLC. This is in relation to an ordinary shareholder. So we're asked here to comment on how the company is doing, but it's from the perspective of an ordinary shareholder. That is very relevant. The answer to this question is suitable mainly for a question targeted at an ordinary shareholder's perspective. As I said, if you were looking at this from the perspective of a bank manager, or looking at the perspective of a debenture holder, these two here, your answer would be quite different. Half of the stuff would be kind of changed, kind of to suit their viewpoint. Whereas with the ordinary shareholder here, we're looking at it from the existing ordinary shareholder. This is a suitable answer. The last time I discussed section 2, I went through this here. I went through a general form of statement about how to answer question really on the part B. This is just kind of a general structure. That didn't apply specifically to any question. So this will be used here today to kind of specifically apply to this question. So Shannon PLC, again, given the profit and loss, given the balance sheet, given information from last year, part A, we had to work out 5 different things, and we've worked all of them out here already. We've gotten the 5. Now it's time to move on to part B. So, indicate if the ordinary shareholders would be satisfied with the performance, state of affairs, and prospects of the company. Use relevant ratios and other information to support your answer. So, couple of different things. You're going to have to work out a few formulas before you get some of these answers. I'm not going to discuss them now because we'll kind of just wrap it up at the end. It'll be quicker to kind of point them out. But we're asked to kind of comment on the company from 3 points of view: performance, state of affairs, and prospects. So if you've noticed here, I have an essay and I've divided the essay up into performance, state of affairs, and prospects. You answer this question in the way they want you to deliver it. We want to see if an ordinary shareholder would be satisfied with the performance, state of affairs, and prospects of the company. We're obviously using relevant ratios to support our answer. So you start off with performance. Performance, there's 2 things we have in performance here. We have profitability and we have dividend policy. As you already have seen from the profitability general kind of skeleton notes, I am more or less filling that in here. I'm figuring out my return on capital employed formula. Again, whenever I reference a formula, all the formulas are given here. This is the return on capital employed one. If you have to work out a formula, obviously you just work out the formula separately. But this is just a comment. So the return on capital employed for 2018, which is this year, is 9.66%. Last year was 5.8%. Where did I get that? Well, they tell us here. Last year's return on capital employed was 5.8%. So what happened? It's increased by 3.86%. This indicates a healthy trend. So return on capital employed, you want that to go up as much as possible. It's the return a company is making on the amount that they have their worth with the company really. Shannon PLC is a profitable company. It's a return of 9.66%. Is better than the return from risk-free investment of 1 to 2%. And that's currently about 1.4%. So the company is making about 9.66%, whereas investment in a risk-free investment would only make 1 to 2% return. So it's better than that, and it's also better than the debenture rate of 6%. They're making efficient use of the resources this year. This is a general skeleton that I've included in the last one. All I've done obviously is I've filled in what the return on capital employed was this year, what it was last year, how much it increased by, and obviously having gone up is a good thing. It's a healthy trend, and they're going to be happy. Why are they going to be happy? Well, 9.6% is a better return than a risk-free investment, and it's also better than the debenture rate. It's worth them getting out the loan and making more profit. So how do you apply this to a shareholder? Well, there's only one thing we need to do here really. We just need to comment at the end, shareholders will be happy with this trend. So profitability is generally quite easy. There's a list of information. You give that for every single question. And at the end here, we've just one line, shareholders will be happy with this trend. The second one we're going to look at is dividend policy. Dividend policy compared to the other viewpoints of debenture holder and bank manager, dividend policy is going to be a good bit more important for an ordinary shareholder. Because what is a dividend? A dividend is money that you give back to a shareholder. It's a return to shareholders. Therefore, this from the perspective of dividends, it's going to be a little bit more important to a ordinary shareholder than it will to a bank manager or debenture holder. So I've actually gone and I've calculated three different things: dividend cover, dividend per share, and dividend yield. You will always have to comment on dividend cover, but because we're looking from the perspective of a shareholder, I'm also going to comment on dividend per share and dividend yield. Again, three formulas for here can be found in the investment, down at the bottom, the investment section here of our formula list. And again, you just fill in the information. We've dealt with calculating those formulas quite a bit already. I'm not going to cover them again. So dividend cover is 2 times for this year. Last year's dividend cover was also 2 times. How do I get that? Well, the dividend cover given for last year here is 2 times. So I'm going to comment on that. I'm going to comment on every formula. I've given the return on capital employed. I've commented. Shareholders will be happy. Dividend cover, I'm told that last year was 2 times, this year it's 2 times. 2 times is about the minimum you want it to be. Sometimes you'd like it to be a little bit higher. So I'm going to say shareholders would like to see slightly more profits being retained for expansion purposes and repayment of loans. Dividend per share has risen from 5 cents to 7 cents. Again, we're not commenting too much, but this is going to be good. So shareholders will be happy. The fact that dividend per share has gone up based on current performance, this trend is likely to continue based on current performance because obviously the company is doing quite well. Dividend yield has improved from 4% to 5.19%. So the shareholders would be happy that the dividend is above the return risk-free investment of 1 to 2%. So again, I'm just kind of commenting on how the company is doing, and I'm comparing it to last year. So last year's figure, the 5 cents from last year was given here for dividend per ordinary share, and the dividend yield from last year is given here. So I have my information from last year. I work on my information from this year, and if it goes up, I'd say whether that's a good or bad thing, and if it goes down, I'll say whether that's a good or bad thing. And that's kind of the way you write it for an ordinary shareholder. Again, it's quite important from an ordinary shareholder. For dividend, there's 7 marks going. If you were looking at this from a bank manager's perspective, you'd probably maybe only just mention dividend cover and dividend per share, and it might only be worth 5 marks. The next thing we're looking at here is the state of affairs. We've dealt with performance. The next thing we're looking at is state of affairs. The two here that I'm going to look at is liquidity and gearing. We've already looked at these for our basic structure, liquidity and gearing. I am more or less just repeating the skeleton notes, and I'm adding in a little bit more again just to make it relevant to the ordinary shareholders. So the first one I'm looking at is liquidity. The quick ratio has improved from 0.86 to 1.07 last year. So last year the asset test quick ratio 0.86, and this year I've worked it out to be 1.07. It's a positive trend and would please shareholders. So you want this to be good, you want this to be high for it to be good, sorry. The ratio is above the ideal ratio of 1:1. Shannon plc does not have a liquidity problem. For every euro Shannon plc owes in the short term, it is €1.07 available in liquid assets. This improvement indicates Shannon plc will have no difficulty in paying shareholders a reasonable dividend. Everything here that I've given in black was part of the skeleton notes already that I had on shareholders. All I've just added in is the fact that this would please shareholders, that it's gone up past the ideal ratio of 1:1, and basically that what's happening. It indicates Shannon plc will have no difficulty paying shareholders a reasonable dividend because they have a little bit more money kind of available to them now. The gearing aspect, here, so liquidity and gearing would be very, very important from a debenture or from a bank's perspective. Also still important from an ordinary shareholder perspective, but we don't need to comment as much. Not as much as we would in terms of the red here. We're not commenting as much from an ordinary shareholder's perspective than we would have done above for dividends. The gearing is improved. It's gone from being highly geared last year at 56% to being lowly geared this year at 46%. So this here we have for our gearing, last year was given at 56%. So So the firm is now financed more by equity than debt and is not dependent on outside borrowing. If you are highly geared, you are more dependent on outside borrowing, more of your company is being financed by loan. So the fact that we've now gone below 50%, we're financed more by our own resources, our own equity, rather than debt, which is a good thing. Again, with gearing, you comment on two formulas. The second one we have here is interest cover. So interest cover has improved from 4.3 times in 2017 to 7 times in 2018. Again, where did you get the information from last year? Interest cover from last year, 4.3 times. Interest cover from this year, you can work out again using the formula to be 7 times this year. So it's improved. The company is able to cover their interest charges, so they're able to cover their interest charges 7 times over from their profit, as the interest cover is above the minimum acceptable amount of at least 2 times. So that's a minimum acceptable amount to be able to cover your interest 2 times. And these two go hand in hand, because the more highly geared you are, the more interest you have to pay. And therefore it be a little bit more difficult to pay off interest multiple times. So the fact that we're lowly geared, it's not surprising that we have a high interest cover. So again, these information here, this is part of the both these paragraphs here are part of the skeleton notes, everything in black. All I'm doing here is I'm just a quick comment on the fact that from an ordinary shareholder's perspective, this improving trend would please shareholders as it makes the payment of interest easier. So it's an improving trend. We've gone down to being lowly geared and our interest cover has gone up. Generally, both of these, if the gearing goes down, the interest cover generally goes up. So just a quick comment, this improving trend would please shareholders. So the last one, I've dealt with performance, I've dealt with state of affairs. Performance, I had to add a little bit more in based on shareholders' perspective, and the state of affairs, really most of this was skeleton notes. It's just quick comments here to say whether it's good or bad. The last one is our prospects. So the prospects, we have two again here, sector and market value of share. So sector, this one here is going to be highly dependent on one line you will see in the question, and you have to run off and write a story based on that one line. The very start of this question tells us the following information has been extracted from the final accounts of Shannon plc, a company involved in the renewable energy industry. They tell you the sector at the top. We're involved in the renewable energy industry. So without me scrolling down, the renewable energy industry. If you were, so we're commenting from the ordinary shareholder's perspective. If you're an ordinary shareholder and you find out a company is involved in renewable energy, is this a good thing or a bad thing? Is it a good sector to be involved in? Is this sector the potential to increase in value in later years? Of course, the answer is yes. Renewable energy is obviously a growing industry. So I have a general statement here. Every time you see renewable energy, this is along the lines of what you're going to need to say. There is a good bit of information, but generally this renewable energy could come up once every 4 years. You do see it quite often. It's a common enough industry to talk about for question 5. Short-term perspectives are encouraging as the company operates in the renewable energy industry, which is a growing industry. More people are becoming environmentally aware. This is information about solar panels here. Long-term prospects are encouraging, so we've commented on the short-term prospects. More people are getting involved in it. Long-term prospects are even more encouraging as oil supplies are expected to be depleted, so eventually everybody's going to need to use renewable energy. So this is a general statement. You essentially are going to have to learn this off for things like this for renewable energy. Um, Unfortunately, here the marketing scheme probably won't do you much justice if you were to do the exam this year. Um, Depending on the industry, you'd be looking at talking about the coronavirus. Um, COVID-19 has obviously affected a lot of industries. The tourism industry has obviously greatly suffered this year. So if you were looking at it from the perspective of an ordinary shareholder, why would you invest in a tourism industry this year? They'd be struggling. You don't expect them to do good from a short term. Maybe long term they'll be able to recover. So you're basically just identifying what industry they're involved in, and you have to be able to comment on that industry from a short-term and long-term perspective, and state basically what you expect from this kind of industry. Is it a good thing to be involved in, or is it a bad thing to be involved in? The final one we have here from the prospects is our market value of shares. This is going to be quite important from an ordinary shareholder's perspective, as we're talking about how much the value of a share is. And obviously investors, the ordinary shareholders are people who invest in shares, so this price is very important to them. So the share price has risen from 10 cent, risen by 10 cent from €25 last year to €35 this year. Well, how do I know it's increased? I know that my market value share last year was €25, and this year it's that share price given here at the bottom, €35. It's gone up by 10 cent. So I'm told that it's increased. It's an 8% increase. Its trend is likely to continue based on this year's performance, because obviously the sector is good, the profitability was good. Everything here has been very positive so far. This company is obviously doing very well. So this will please shareholders as it indicates stock market confidence in the company. Basically, investors are going to be confident that this company is going to do well. So the share price is likely to increase even more, which is obviously a good thing for a current shareholder. The other thing we're going to talk about here is based on current earnings, price earnings ratio last year was 12.5 years, and this has improved to 9.6 years this year. This will please shareholders as it means it will take a shorter time period for an ordinary shareholder to recover his or her investment in one share. Again, I'm commenting on this, making it relative to the ordinary shareholders, but the price earnings ratio, there's one thing I do have to cover for this here. So we've already figured out, because it was in part A, and you know the formula, the price earnings ratio for this year was 9.6 years. But the price earnings ratio for last year, this is the only thing that I've had to work out for last year. As you can see, the price earnings ratio for last year was not given. I'm not told it here. So how do I know the price earnings ratio for last year was 12.5 years? Well, the formula for price earnings ratio is here. It's share price divided by earnings per share. So do I have the share price last year, and do I have the earnings per share last year? I do. I have both. My share price last year is here. My market value, my share price is €25, and divide that by the earnings per share of 10. So that gives me my 12.5 years, 125 divided by 10. That gives me my 12.5 from last year. So I know the price earnings ratio from last year was 12.5 years, and I know it's gone down to 9.6 years, which is a good thing. From a price earnings ratio, you want it to be as low as possible, because it means you get a quicker return on your investment in one share. Again, this is the profitability, state of affairs, and prospects of the company. The one thing I skipped over at the start, and it is very important, is we're told to indicate if the ordinary shareholders would be satisfied with the performance. You're not always told this. For example, I'm going to go on to the 2017 question now, and it looks completely different. Advise the bank manager of this. If I go to 2011, advise the bank manager. Okay, so every year it's going to be different. would you be shareholder? Would you as a shareholder be prepared to purchase more shares? But in this particular year, we were asked to indicate if the ordinary shareholder would be happy. I have commented on that for each section here, but I need to make a general statement too, so I actually did that at the start. I'd recommend you to leave a couple of lines free if you were to see this line, indicate if the ordinary shareholders would be happy with the performance. Leave a couple of lines free at the start. Work out how the company is doing, and obviously from this here I can see that everything has gone up. The company is obviously doing very well and the shareholder would be happy. So I'm basically stating shareholders would be very satisfied with the performance, state of affairs and prospects of the company for the following reasons. But I can't really comment on this until I've kind of gone in depth through the company. So I'd leave a couple of lines free at the start, or maybe you can put it at the end, but I think it's nicer to start with it. The examiners look at your answer and they can see that straight away, okay, this candidate kind of knows what they're talking about in terms of how the company is doing. So kind of leave a little bit of space free at the start. That's if they ask you to indicate if the ordinary shareholders would be happy, which only comes up maybe every 3 or 4 years. The ordinary shareholders will be very satisfied with the performance, state of affairs, and prospects of the company. So that is a part B from the perspective of the ordinary shareholders. Everything I have in here in red, which you will see, this is on your OneNote here, 5th year accounting. Everything I have here in red is basically every time I've applied it to a shareholder. You need to apply this to the question. If I was to give you a banking or a debenture holder viewpoint, all of this would have to be different. It would all have to be from the perspective of a bank holder and debenture, bank manager or debenture holder. So we'll get to them in due time, but this is for an ordinary shareholder.